Bitcoin just lost $67,000 and the Fed hasn't even spoken yet. That record available cash in the market dump means something bigger is cracking in this bull market. Markets closed Friday, June 26, 2026. Here is where everything ended the week. Like and subscribe for daily market updates. Today's agenda: Friday's big move, market snapshot, Fed watch, global tensions, crypto and Bitcoin, tech earnings. Up next, market snapshot. The Russell reconstitution executed during Nasdaq's closing auction shuffled $334 billion of equity in merely 1.6 seconds. This velocity represents more than triple the volume seen at this same moment last year, cementing a narrative that dominated the entire week, a quiet yet violently aggressive rotation out of big tech and into almost every other sector. The S&P 500 closed Friday nearly perfectly flat near 7,354. An appearance of calm on paper masks a profound structural shift underneath. This split defines current market reality because capital did not flee the system. It simply changed seats from expensive growth names to value, and small caps seeking yield in a higher-for-longer rate environment. Historically, such rapid intraday shifts often precede regime changes, where available cash in the market dries up for mega-cap monopolies, while finding new homes in industrials or energy. This mechanism matters deeply because the disconnect between headline indices and underlying breadth suggests earnings expectations are being repriced faster than underlying health can adjust. Investors holding concentrated portfolios of tech giants face immediate margin calls as unpredictable price swings expands, forcing a defensive posture before Monday opens. Conversely, those positioned in small caps may find support strengthening if rate cuts materialize sooner than expected, though the path remains choppy until inflation data clarifies the Fed's next move. The real story isn't where prices went today, but how money moved to get there. This signals that the bull market is evolving from a growth-led sprint into a broader, more resilient grind driven by value rotation rather than pure speculation. That brings us to Federal Reserve Watch. Let's examine the numbers that truly matter, because surface-level indices often mask profound structural shifts beneath them. The S&P 500 closed at 7,354, appearing flat but hiding a dangerous rotation of capital away from growth into defensive value stocks. This divergence signals growing investor anxiety about valuation sustainability rather than simple market indecision. Meanwhile, the Nasdaq fell for its fifth straight session and dropped roughly 4% as investors fled crowded bets on artificial intelligence. After months of relentless price appreciation pushed how expensive assets look relative to earnings to unsustainable extremes. That matters critically because tech was the only engine driving this bull market until now. Without it, broader equity gains would likely stall entirely given current interest rate environments, where high yields make non-tech assets more attractive. Conversely, the Dow Jones finished just below a record near 52,000, while small caps in the Russell 2000 closed green above $3,000 for the first time in months, suggesting capital is seeking safety in companies with tangible earnings and lower debt loads reminiscent of late 1980s market corrections. Oil sits at $69 per barrel, and Brent is near 72 as traders brace for a global supply glut once Gulf output fully returns to normal levels after recent tensions eased up. Historically, when oil prices stabilize, while how expensive assets look relative to earnings compress, it often marks the beginning of a multi-year cycle, where industrial sectors outperform software giants. For investors, this implies a necessary rebalancing, reducing exposure to overhyped AI names before earnings reports reveal weak underlying health, and increasing positions in energy infrastructure or consumer staples that benefit from lower input costs without relying on speculative growth narratives. Which leads to global tensions. The Federal Reserve held its benchmark rate steady last week at 3.5 to 3.75%, but the dot plot showed 9 of 19 officials penciling in at least one more hike instead of a cut. Markets are pricing roughly 60% chance of that hike by September and around 80% by December because sticky inflation is still running hot. The PCE index sits at 4.1% a year, which is the hottest reading in more than 3 years. Yet Friday brought a glimmer of relief as consumer surveys showed expectations easing to 4.6% for next year. Underpinning it all, the economy remains strong with revised figures putting first quarter growth at 2.1%. So this picture looks like a finely balanced tug-of-war between a Fed itching to tighten against faint signs that inflation may be cresting. Here's crypto and Bitcoin. Overseas, geopolitics remain volatile as Middle Eastern tensions simmer. Initially, global markets displayed reflexive indifference, a complacency investors now deem perilous. President Trump escalated rhetoric by accusing Iran of breaching the fragile ceasefire via attacks on cargo vessels in the Strait of Hormuz, a choke point moving roughly one-fifth of the world's oil supply. Simultaneously, U.S. officials shifted blame to Tehran regarding an assault on a tanker off Oman that briefly halted regional evacuation efforts. However, crude prices dipped again because market mechanics rely on physical logistics rather than headlines alone. Pricing action reflects real-time disruptions in shipping schedules and inventory flows. Despite diplomatic friction, dozens of merchant vessels navigated daily operations, while Saudi barrels remained afloat on export tankers. Furthermore, the 60-day peace roadmap signed in Switzerland continues to hold firm structurally, providing a temporary floor for regional stability that prevents immediate supply shocks. The critical lesson traders extract is nuanced. Inflammatory statements carry significantly less weight than tangible reality of unimpeded tanker traffic crossing international waters. Historically, markets punish perceived threats to flow more severely when actual delays occur, as seen during previous Gulf conflicts, where price spikes correlated with blockade fears rather than verbal disputes. Consequently, investors must recalibrate risk models to focus on supply chain continuity metrics instead of political noise. For portfolio managers and institutional buyers, this implies hedging strategies should prioritize physical inventory levels and shipping lane security over reacting solely to headlines. The current environment suggests that, while words stir investor mood, true unpredictable price swings depends on whether oil physically reaches refineries without interruption. On to tech earnings. That calmer energy backdrop rippled across commodities, but crypto is where the real damage showed up this week, revealing deep cracks in an asset class that many still treat as digital gold. Bitcoin plunged to around $58,000 intraday on Friday, before clawing back just under $60,000, having shed nearly 19% in June alone. The driver here is structural, because spot Bitcoin ETFs logged their biggest daily outflow since May after years of growth effectively stalled as they flipped from soaking up coins to dumping them instead. This reversal marks a significant shift in institutional investor mood. Previously viewed as a hedge against inflation and currency debasement, the asset now faces challenges similar to those seen during the 2018 bear market, when regulatory uncertainty and borrowed money unwinding drove prices down rapidly before stabilizing. A $10.5 billion quarterly options expiry plus a wave of forced liquidations landed right on top of that momentum shift, pushing the fear and greed index into extreme fear territory immediately. When large holders begin selling to cover short positions or rebalance portfolios away from volatile assets, it creates a feedback loop where falling prices trigger more sell orders, amplifying unpredictable price swings far beyond what underlying health alone would suggest. For now, Bitcoin is trading like the riskiest tech stock on the board, rather than acting as a safe place to store wealth. Investors must recognize that without renewed inflows or clearer regulatory clarity, this asset class has transformed from a diversifier into a high beta leveraged position, susceptible to big-picture economic raising interest rates and available cash in the market crunches. Those holding long-term positions may find themselves forced to realize losses if the floor breaks below key psychological support levels, while new entrants should treat allocations with caution until unpredictable price swings metrics normalize. The market is signaling that crypto's era of unbridled expansion has paused for a period of painful recalibration, where only the most resilient projects and holders will survive without significant downside protection. Now let's wrap up with what actually matters for your portfolio as we head into the weekend and beyond. The week's market rotation was driven largely by technology sector success, though the outcome feels ironic to many observers. Just a day after memory chip maker Micron posted blowout earnings and soared in price, its stock reversed sharply on Friday, falling almost 7%. This decline dragged down the entire chip complex as investors now fear that soaring costs are bills the rest of tech will have to pay eventually. Apple remained under pressure because it raised prices on its Macs, citing those very chip costs. This move hurts demand rather than helping margins directly overnight in today's report. The market mood was set early by a bombshell regarding OpenAI, which is reportedly weighing pushing its giant initial public offering into 2027 instead of debuting below $1 trillion valuation. This news sank SoftBank as much as 12% and triggered circuit breaker halts globally across major exchanges. Investors are increasingly concerned that the cost pressures currently being absorbed by chip manufacturers will eventually ripple through other segments, forcing broader technology companies to cut spending or raise prices further. The reversal at Micron highlights how quickly sentiment can shift when earnings expectations no longer align with operational realities. While Apple's price hikes aim to protect margins against expensive components, the immediate reaction was a drop in demand rather than an improvement in profitability metrics for the quarter. Similarly, OpenAI's potential delay of its IPO suggests that even massive valuations face scrutiny as investors reassess growth trajectories and funding requirements. These developments underscore a market where initial optimism can vanish quickly when underlying cost structures or regulatory hurdles emerge. The global impact was felt immediately with trading pauses designed to allow time for information dissemination before orders could resume normal flow. This week, the market rotated rather than fell, shifting leadership from major technology names toward healthcare banks and small caps. Friday's record reconstitution cemented this change by promoting companies like Apple, while removing Alphabet from key indices ahead of Monday's new Russell launches. The primary risk now is that the AI-driven bull market could crack under rising costs and slowing consumer electronics demand. Investors are rapidly fleeing crowded artificial intelligence bets, which may cause real pain for portfolios with heavy tech exposure. Meanwhile, watch Bitcoin closely. A break below 58,000 tomorrow morning could trigger panic selling before Monday opens. Thanks for watching Market Pulse Daily.